All right. I'm going to start recording.
Okay.
All right, so now we're officially recording. Thank you, too, for showing up to keep me company while I do this. I'm going to go ahead and start here. I'm going to do first this problem for us, and then we'll stop the recording, and then that way it'll just be one little chunk. Then we can chat for a minute. Then I'll do this one, too, and then we can stop the recording again. And then if we do it well, we can get through this one too, because my guess is, Lupita, everybody is going to want to do this one because it's the shortest one.
Yes, probably.
The fourth?
Number 4 bonds.
Okay.
Number 4 bonds.
The TTM is short also. That's
Yes.
why I thought that maybe the fourth one is more larger.
Okay, so starting to share all of my screens, let's start looking at the 2 different problems that were within the stocks. So here's what I'm going to do for you is off to the side. When we think of how to determine the value of stocks, we think of there as being 2 primary ways that you can do stock valuation. The first one we're going to do is what's called the Gordon Constant Growth Model. So if you would like more information about that, it's easily Googled, and you can see the background and the simplicity of the formula that we are going to create there. In addition to that, we are going to use what's called CAPM, which is the capital asset pricing model, which again is something that you can Google, and those things will help us over into our assumptions to look up a company and figure out whether or not we think we should be investing in that company. Down here, we're going to use a slightly different tactic. We're going to use what's called the dividend discount model. I'll explain that one when we get down below. But up here, we're going to just focus on these 2. So let's let the instructions lead us through the problem solution. So we're going to look up Procter & Gamble on Morningstar. What is the next dividend per share that they're going to pay? What is the beta of the stock? The NASDAQ is predicted to earn 13% for the next 5 years, and the current risk-free rate is 1%. What would you consider to be a fair price to pay for Procter & Gamble today? Then what is its market price, and should you buy it, yes or no, are the questions. So let's start by doing the research. So over here, I brought up Procter & Gamble on Morningstar. And let's take a look and see if we can find some of the information that it was asking for. So first thing it's telling us is the current price is $128.07, or 70 cents, right? 128.70. Great. That's the market price. So eventually that's what we're going to ask ourselves is this a good price to pay? Is it too high? Or is it too low? And then, what is the dividend per share to be paid, and what is the beta? Well, as I'm looking through here, what I'm going to show you is something neat. Let's see if we can find it together. I'm going to click on this chart, and we're going to go ahead and take a look at Morningstar's chart here. And there are all these different buttons up here that we can choose. Everything from the type of display that we want to see to we can actually draw on top of it. This has some different characteristics that we want to see. And then events and indicators is my favorite. What if we go ahead and click on this dividends one? And then from there, let's look at a 1-year dividend chart. Everywhere you see a little D, for example, it tells you that Procter & Gamble on 4/24 of 2020 paid a dividend of 79 cents per share. Then in July, it paid a dividend of 79 cents per share. And then in October, it paid a dividend of, what was that one? Also 79 cents per share. And then just recently, it also paid a dividend of 79 cents per share. So let's go ahead and notate over here that the dividend that it is supposed to pay next is going to be 79 cents, and I just want to make sure, per share. But what did you notice about the dividend that it just paid? It paid a 79-cent dividend. How often? Go back to our chart. How many times a year does it pay a dividend? 4 different times a year. So if we were to annualize this, for example, what did we know? That the dividend that it just paid was 79 cents, but it was paid 4 times for the year. So they just paid an annual dividend of $3.16. Now, we can look at then is what were they paying 5 years ago? So why don't we go ahead and look at a much bigger chart that shows us then if this is 2020, year 1, 19 would be 2 years ago, 18.3, 17.4. Aha, here's our dividends in 2016. They measured 67 cents, 67 cents, 67 cents, and 67 cents. So our dividends were 67 cents that they paid us 4 different times. And that occurred but over a, let me see, just making sure I gotta check here. Sorry, I got this one. Oops, that's the answers. Put the answers away, Al. That occurred over the last 5 years. Just like we did in the previous time value of money section then, when we want to analyze growth rate, this would also be what we would know as the rate function. The rate function looks at growth rates. So if into formulas, financial, and we find the formula for rate, we can say over a 5-year period when there was no payment, when the beginning value was a negative 268 that grew into a future value of $3.16, it calculates for us then that the growth rate has been about 3.35%. Why does that say 3.43, 316, 260? Oh, because of the way I multiplied. That'll be fine. 3.35 will work. My answer says 3.43, but that's because there's some rounding in there. We won't concern ourselves that that's our first thing. What we can say is the dividend has been growing about 3% every single year. Why this is important? Because when we do the Gordon constant growth model, and if we were to come over here and look up the Gordon constant growth model, I like Investopedia a lot. I also like the Corporate Finance Institute, which does a great job of explaining the Gordon constant growth model that comes with a basic formula attached to it that says what we need to be able to predict is what we think the next dividend will be, and then divided by the rate we think it should earn us, divided by the growth. So if I dump that over in here, that's going to help us get to the final outcome. Now, this part is really interesting to me. This part is what's called the capital asset pricing model. So if we were to look up the capital asset pricing model, and although it has lots of ugly pop-ups it brings up, I still like looking at formulas within this Corporate Finance Institute because it tells you right here the rate that you would expect is equal to the risk-free rate plus what we think of as being the difference between what the market will produce and what the risk-free rate will be. So let's see how you execute that. First thing we have to do is ask, what do we think the market is likely to do in the future? And so according to the research that was provided in the problem up top, we expect the stock market to grow by 13%, so that any investor who invested in a broad portfolio of the market would expect this annualized growth. If they don't want to take any risk, then any investor should be able to invest and earn a 1% rate of return, which means that if you invested in the market of stocks versus the market for no risk, you should make 12% more points by being able to take that risk on. But Procter & Gamble is a company that sells like toilet paper and shampoo. And what we look at is, well, how risky are they compared to the world of investing? And if we come back to that main page on Procter & Gamble again, you see that there is a beta measure. The beta measure is why in an MBA program, we focus on statistics. This is a correlation coefficient, which suggests that anytime the market goes up by 1 percentage point, this particular stock will go up by about 40% of what the market does. Whereas if the market was to go down by a percentage point, this would go down, but not a full percentage point, maybe only 40% of what the market does. Oops. With that in mind, we can then use this formula that we found on Corporate Finance Institute and figure out how can we determine what the expected return of the security should be. So let's go ahead and put this off to the side over here. Let's put this here and see if we can cross-reference this formula and make it work. So the expected rate of return is equal to the risk-free rate of return. So this right here, plus open a parenthesis, and then I'm going to take my beta, that's this measure right here, close my parenthesis there, and multiply it by, open another parenthesis, take my market rate minus my risk-free rate, close that parenthesis there. And what this suggests is then, while the overall market might be expected to earn 13%, because Procter & Gamble is a less risky company making consumer staple items, I would expect them to yield me only 5.92%. All right, next thing we have to do is say, this is all based off of history. What we really need to know is what comes next. What is the next dividend that Procter & Gamble is going to pay? Now, let me go ahead and pretend that I'm a student for just a second and I have no idea how to do this. What if I just went ahead and typed in Procter & Gamble next dividend? Dividend. Who brings up what for me? Look at, they even summarize it. Procter & Gamble will begin trading an ex-dividend as of January 21st. A cash dividend payment of $7.91 per share is scheduled to be paid on February 26th. Oh, okay. Isn't that what we had figured out over here? That's why our formula is off a little bit. Let's see this. See that? How there's a little bit of rounding when I put that little piece in there. It gave us up to 3.38. I'll take it off though, since we did it before. All right, so what that suggests then is we have to figure out then, what is their next dividend look like? Well, they look to me like they're paying the exact same next year as they have been last year. So this is my expectation of what I could earn if I were to buy that stock. So how do we put this all together now? The Gordon constant growth model says we're going to take that dividend, we're going to divide it by the rate that we expect and subtract off the growth. So we are going to take that dividend, divide it by the rate that we would expect, subtract off the growth. And we think that as of right now, the fair price that you should pay for this stock is $122.96, where the market is asking $128.70. So the question we can ask is, should you buy this stock or not? So we can add a little simple Excel logic that could say this, equals if, open a parenthesis, if the fair price, the price we're willing to pay, is greater than what's in the market. So if we think something's worth $1 million and someone's only asking $128, then we could say buy it. But the opposite is true. If that fair price is less than the market price, then we could say do not buy. Because the fair price is lower than the market price, using the Gordon constant growth model and using the capital asset pricing model, we can determine that right now Procter & Gamble's stock is slightly overvalued and we shouldn't buy it.